Let's be honest, the way we move money is fundamentally broken. Have you ever tried to send money to family overseas only to watch a huge chunk of it disappear into fees? Or maybe you're a business owner waiting anxiously for days for a critical payment to clear, a payment you needed instantly. What if I told you that this entire system, a relic defined by banking hours, frustrating delays, and a shadowy network of expensive middlemen, was on the verge of becoming obsolete? While the world has been captivated by the wild price swings of Bitcoin, a quieter, more profound revolution has been steadily gaining ground. This isn't a story about getting rich quick. It's about a complete re-architecting of the global financial system's plumbing. It's about making money move at the speed of the internet for everyone, everywhere. This is Thean Oe's story of stablecoins. It's the story of how these digital dollars are already making instant 24/7 transactions a reality for everything from online shopping to multi-million-dollar corporate deals. And it signals nothing less than the beginning of the end for banks as we've known them for centuries. To really get the magnitude of the change that's upon us, we first need to understand just how clunky and inefficient current financial system is. When you click send on an international bank transfer, you're not just sending money from point A to point B. Instead, you're kicking off a slow, expensive, and ridiculously complicated game of telephone. Imagine you want to send money from the US to a friend in the Philippines. Your money doesn't go directly. First, it goes from your local bank to a massive correspondent bank. That bank then sends a message, not money, just a message, through a system called SWIFT to another correspondent bank in the Philippines. That bank then tells your friend's local bank to credit their account. Finally, after several days and multiple handoffs, the money shows up. Each step in this chain is another institution with its own fees, its own business hours, and its own ledger. The result is a process that's painfully slow, often taking 2 to 5 business days. It's an architecture designed for a world of paper ledgers and telex machines, awkwardly patched onto our digital lives. Even global financial regulators have pointed out that traditional cross-border payments are plagued by high costs, low speed, and a stunning lack of transparency. This isn't just an inconvenience. It's a massive multi-billion-dollar tax on the global economy. The most obvious cost is in remittances, the money migrant workers send home to their families. According to the World Bank, sending international remittances costs an average of 6.49% of the total amount. Think about that. For every $200 sent, nearly $13 is just lost to middlemen. That's not a rounding error. It's food taken off the table or a school fee left unpaid. Banks are often the most expensive channel for these transfers, with average costs sometimes soaring to over 14%. For businesses, the costs are even bigger. Companies trading internationally are constantly fighting with unpredictable settlement times, which traps their cash and creates huge operational headaches. They also face massive foreign exchange or FX costs. When a company in Europe buys goods from Japan, the banks involved don't just convert euros to yen at the market rate. Now they take a spread, a hidden fee baked into the exchange rate that can add up to tens of thousands of dollars on large transactions. The system runs on friction and opacity. Beyond the costs, there's a fundamental problem of access. The traditional banking system is exclusive, leaving billions of people around the world unbanked or underbanked and locked out of the digital economy. And finally, the whole system operates with a 9 to 5 mentality in a 24/7 world. Commerce, communication, and life happen around the clock. Yet our financial system still grinds to a halt on weekends and holidays. A payment sent on a Friday afternoon might not even start its journey until Monday morning. In the age of instant everything, that's not just bizarre, it's unacceptable. This is the central problem that has set the stage for a revolution. Before we get to the technology that's rebuilding our financial plumbing, we have to talk about the one that fired the first shot, Bitcoin. For over a decade, Bitcoin has been the face of the crypto revolution, and its biggest contribution was introducing a radical new idea, a global, decentralized, digital store of value. Bitcoin's genius is its unchangeable scarcity. there will only ever be 21 million Bitcoin. Unlike national currencies, which can be printed at will by central banks, Bitcoin's supply is fixed. This has led to its narrative as digital gold. In a world of rampant inflation, some of the world's largest financial institutions have started to see Bitcoin as a crucial hedge to preserve wealth outside the control of any single government. This isn't a fringe theory anymore. The success of Bitcoin ETFs in the United States has opened the floodgates for institutional capital, legitimizing it as an asset for pension funds and corporate treasuries. Public companies like MicroStrategy have even adopted a Bitcoin standard for their reserves, holding billions of dollars worth as an inflation hedge. The policies of central banks, like printing trillions of dollars, can devalue traditional currencies and push investors towards scarce assets like gold, real estate, and now Bitcoin. But here's the critical distinction, the pivot on which our entire story turns. Bitcoin is a revolutionary asset, but it's not revolutionary money for everyday use. Its design makes it incredibly secure, but also relatively slow and expensive for small daily payments. More importantly, its price volatility, which creates so much opportunity for investors, makes it completely impractical for commerce. A coffee shop can't price a latte in Bitcoin if its value could swing 10% before the day is over. So while Bitcoin broke the mold, it left a crucial problem unsolved. It gave us digital gold, but it didn't give us digital cash. It fired the first shot in the revolution, but it didn't provide the tools to rebuild the system. For that, the world needed something else. It needed the stability of a dollar with the technology of a cryptocurrency. It needed a digital dollar. This is where the real revolution in payments begins. This is where we meet the hero of our story, the stablecoin. The concept is elegantly simple. A stablecoin is a cryptocurrency whose value is pegged to a real-world asset, most commonly the US dollar. For every one stablecoin in circulation, there is, in theory, one US dollar held in reserve in a bank account or in short-term government bonds. Think of it like a poker chip at a casino. You hand the cashier $100 and get $100 worth of chips. Those chips aren't an investment, they're a claim on the $100 you provided. Stablecoins are like poker chips for the internet, digital tokens that represent a claim on a stable, government-issued currency. This solves the volatility problem, giving you the price stability of the dollar combined with the tech advantages of a cryptocurrency. Now, not all stablecoins are created equal. The vast majority, and the ones powering this revolution, are fiat collateralized stablecoins. Issuers like Circle with USDC and Tether with UST hold reserves of actual US dollars and treasury bills. Trust is built on transparency, with these issuers undergoing regular audits to prove their tokens are fully backed. There are also crypto-collateralized stablecoins, which are backed by a surplus of other cryptocurrencies locked in a smart contract. It's a more complex and inherently riskier model. Finally, there was the infamous category of algorithmic stablecoins. These were experiments that tried to maintain a peg using complex algorithms with no reserves at all. The spectacular collapse of one such project, Terra/Luna, in 2022 wiped out tens of billions of dollars and served as a stark warning, but that failure was crucial. It forced the industry and regulators to differentiate between risky experiments and fully reserved audited stablecoins, ultimately strengthening the case for the latter. So how do these digital dollars actually move? They run on the same technology that underpins Bitcoin, the blockchain, but you can forget the jargon. At its core, a blockchain is just a shared digital ledger, like a global spreadsheet that anyone can see, but no one can tamper with. When you send stablecoins, the transaction isn't routed through a maze of intermediary banks. Instead, it's broadcast directly to a decentralized network of computers that validate it and add it to the shared ledger. This peer-to-peer system completely cuts out the middlemen. There are no correspondent banks, no clearinghouses, and no SWIFT messages. This architecture unlocks the superpowers of stablecoins. Because the blockchain network operates 24/7, 365, transactions are instant day or night. Because it cuts out the middlemen, the cost of a transaction plummets from a percentage of the total to just a few pennies, no matter the amount. And because every transaction is on a public ledger, it offers a level of transparency the old system could never match. This combination of stability, speed, low cost, and transparency is the formula that's about to upend global payments. This isn't some far-off future. The stablecoin revolution is already here, and the numbers are staggering. In 2024, the total annual transfer volume for stablecoins reached a colossal $27.6 trillion, a figure that surpasses the annual volumes processed by payment giants like Visa and MasterCard combined. Now, let's be real. A huge chunk of that volume comes from automated trading bots and crypto-native activities, not from people buying coffee. Research from Visa and Allium Labs has suggested that less than 10% of stablecoin transaction volume is organic, meaning it comes from real people. But even with that caveat, the growth in legitimate payment-related transactions is explosive. One analysis shows that when you filter out the bot activity, the annual volume of organic stablecoin transactions grew from $3.29 trillion in 2021 to $5.68 trillion in 2024. The number of active stablecoin users has also exploded, hitting 30 million by February 2025. This is the clear signal of a technology moving from a niche to a foundational layer of global commerce. The most powerful application today is in business-to-business, B2B payments, and corporate treasury. Instead of waiting days for a swift transfer, a company in the US can now pay a supplier in Europe in seconds using a stablecoin like USDC. Financial giants are leading the charge. JP Morgan's own private stablecoin, JPM Coin, was already processing $1 billion in transactions per day for its corporate clients back in late 2023. This isn't an experiment. Major corporations are using it for 24/7 cash management. Payment processors are also all in. PayPal launched its own stablecoin, PYUSD, and is integrating it for cross-border payments through its hyperwallet service to cut costs for its millions of merchants. And in a massive signal of commitment, Stripe acquired the stablecoin payment platform Bridge in a deal reported at $1.1 billion. Even Visa is actively expanding its stablecoin settlement capabilities, integrating USDC directly into its network. The impact on remittances and financial inclusion is even more profound. The old system takes an average of 6.49% from the world's lowest income workers. With stablecoins, that cost can plummet to less than 1%. A worker in Dubai can send $200 to their family in the Philippines instantly with just a smartphone. The family receives it in minutes and can convert it to local currency or increasingly spend it directly. This bypasses the need for a bank account, a critical feature in regions across Africa, Asia, and Latin America, where mobile phones are far more common than bank accounts. This also unlocks new possibilities for the e-commerce and creator economy. High credit card fees make micropayments, tiny payments of $1 or less, impossible. With near zero fees, stablecoins make them profitable. A reader could tip a writer a few cents for an article, creating entirely new revenue streams. The evidence is clear. From the boardrooms of the world's biggest banks to the smartphones of workers in emerging markets, stablecoins are being adopted as a better way to move value. They are faster, cheaper, and more accessible. This isn't about a sudden collapse of banks, but about their core function as slow, expensive middlemen being made obsolete by superior technology. Of course, no revolution is without its challenges, and the biggest hurdle for stablecoins has been regulatory uncertainty. For years, the digital asset space has been a gray area, but that fog is finally clearing. In a landmark moment for the industry, the United States passed the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or the Genius Act, which was signed into law on July 18, 2025. This was the first major piece of federal legislation to create a comprehensive regulatory framework for payment stablecoins in the U.S. The Genius Act sets clear rules mandating that issuers must be licensed and, most importantly, that they must maintain one-to-one reserves with high-quality assets like U.S. dollars and short-term government bonds. It also requires regular audits, bringing much-needed trust to the sector. This isn't a threat to stablecoins. It's the single biggest green light for their mainstream adoption. It provides the legal clarity that large conservative institutions need. It separates legitimate, fully backed digital dollars from risky experiments. The passage of the Genius Act, along with similar frameworks like Europe's MiCA regulations, which came into full effect in 2024, is a clear signal that governments see well-regulated stablecoins not as a threat, but as a financial innovation that can boost their own currency's role in the digital economy. The shadow of past failures, especially the collapse of the algorithmic stablecoin Terra Luna, still worries people. But it's crucial to remember that was a failure of a flawed, uncollateralized design, the digital equivalent of a bank with no assets in its vault. The new regulations like the Genius Act are specifically designed to prevent that exact scenario by legally requiring that every stablecoin is fully backed by real, verifiable assets. Finally, there are debates about centralization. The largest stablecoin issuers are private companies, meaning they can freeze funds associated with illicit activity. Some crypto purists argue this goes against the decentralized ethos. For mainstream adoption, however, this is seen as a feature, not a bug. It allows stablecoins to integrate with the existing legal and financial system, providing a trusted bridge between the old world and the new. The road ahead isn't about destroying the old system, but about building a better one on new foundations. This is one of the biggest and fastest moving shifts happening in finance right now, with huge implications for everyone. So, what do you think? Are regulated stablecoins the inevitable future of money, or will traditional banks find a way to adapt? We want to hear what you think. Let us know in the comments below. And if you're getting value from this deep dive and want to understand the future of finance, make sure to hit that subscribe button. We are at a pivotal moment in the history of money. The financial system we've relied on for a century, a patchwork of slow, expensive, and exclusive gatekeepers, is being challenged by a technology that is just fundamentally better. Bitcoin lit the spark, but it's stablecoins that are now carrying the torch, rebuilding the very plumbing of global finance. This transition is no longer a distant forecast. It's happening now, proven by trillions of dollars in transaction volume and adoption by the world's largest financial institutions. The end of banks doesn't mean your local branch will vanish tomorrow. It means their core function as gatekeepers of the payment system is becoming obsolete. Their monopoly on moving money is being broken by an open, instant, and global network that's accessible to anyone with a smartphone. The future of money is being written in code on blockchains. It's digital, it's instant, it's transparent, and it's finally becoming open to everyone.